If you have more than $10,000 sitting in your regular checking or savings account right now, I need you to stop and hear this. Your bank has already reported you to a federal agency, and it is legally forbidden from telling you that it happened. And that is not even the dangerous part. The dangerous part is what most seniors do the moment they find out, because the move that feels the safest is the exact move that can turn your own clean, legal, hard-earned savings into a federal criminal investigation. There is a second report, with no dollar limit at all, that can be triggered by a withdrawal as small as $200. There is a new law that lets your bank freeze every dollar you own for up to 15 business days and smile at you while it does it. And there is one decision that loving families make every single day thinking they are protecting their money that can hand an entire lifetime of savings to a divorce lawyer, a creditor, or the wrong child entirely. None of this is on your statement. None of it was explained when you open the account. The bank has no reason to tell you and every reason not to. Here is the part one I need you to hold on to. Almost everyone watching this right now is not doing anything wrong. Your money is clean. You earned it. You saved it your whole life. But there are 7 specific moves that ordinary, honest, good seniors are making with their own legal money right now in 2026 that are putting them directly in the crosshairs of federal monitoring, triggering automatic government reports, and in some cases, silently handing their savings to exactly the wrong person. Here is what I am going to walk you through today. The exact dollar amount that files a report with your name on it. The one instinct that feels smart but is actually a federal felony. The invisible report that has no minimum and that your bank is forbidden from telling you about. The 15-day freeze that can lock you out of your own money. The protection line that most seniors have never checked. The joint account mistake made out of love that destroys families. And the one free 10-minute fix at your bank that quietly solves almost all of it. If you have not subscribed yet, then you are already behind, because the people who have subscribed are already ahead of you, saving their money by getting the notifications of the video daily. Number 1. The $10,000 line that puts your name in a federal database, and what that actually means for you. Under a law called the Bank Secrecy Act, which has been on the books since 1970, every bank and every credit union in this country is legally required to file an automatic report the moment you deposit or withdraw more than $10,000 in cash in a single day. That report is called a currency transaction report, and here is what most people get wrong about it. It does not go to the IRS. It goes to a bureau inside the Treasury Department called the Financial Crimes Enforcement Network. A name most Americans have never once heard in their lives. Your bank files it without asking you. You do not sign anything. You do not get a copy. You will almost certainly never know it happened. The bank has 15 days to send it in and keeps the record for 5 years. And here is the part that matters most. This report by itself does absolutely nothing to you. It is routine paperwork. It is filed millions of times every year, and the vast majority of those reports are never looked at by a single human being. If you sell your car for $12,000 cash and deposit the whole thing at once, a report gets filed and your life continues exactly as it was. Hold on to that fact very tightly, because what I am about to tell you next is where good, honest, careful people accidentally walk straight into a trap. Number 2, the move that feels safe, the move that is actually a federal felony, and the reason the amount does not matter at all. The moment most seniors hear about the $10,000 rule for the first time, the instinct kicks in immediately. They think, okay, I will just keep it under that number. I will deposit $9,000. I will bring in $4,000 this week and $4,000 next week. I will split it up into smaller pieces. That instinct feels careful. It feels smart. It feels like you are protecting yourself. That instinct is a federal felony. The act of deliberately breaking your deposits into smaller amounts to stay under the $10,000 reporting line is called structuring, and it is illegal under Title 31 of the United States Code, Section 5324, regardless of whether your money is clean. It does not matter that every dollar is legal. It does not matter that you earned it honestly over 40 years. It does not matter that you are hiding absolutely nothing from anyone. The act of trying to stay under the number is itself the crime. The penalty is up to 5 years in federal prison and fines up to $250,000. And the government can seize your entire account through civil forfeiture, which means they can take every dollar without ever formally charging you with anything. There are documented real cases: widows, small business owners, retired school teachers, people whose money was completely legitimate, every single dollar, who had their life savings taken by the government because their deposit pattern looked like structuring. The rule that keeps you completely protected is simple. Deposit all of it at once. Every dollar. Keep a clear record of where it came from. A bill of sale, a letter from an attorney, a note from your child. Never break it up to stay under a number, because the only thing that turns honest money into a federal case is the act of trying to hide it. Number 3, the report with no minimum. The one your bank is forbidden by federal law from telling you about, and why it may have already been filed on you this week. On top of the $10,000 report, there is a second one that almost nobody knows about. It is called a suspicious activity report, and this one has no floor, no minimum at all. A bank can file a suspicious activity report on a transaction of $500, $200, any amount it chooses. And here is what makes this one completely different from the first. It is a federal crime for a bank employee to tell you that one has been filed on your account. So you could be flagged right now, this week, and have no legal way of finding out. What sets it off is not the size of the money. It is any change from your normal pattern. If you have withdrawn $300 every single week for the last 10 years, and you suddenly walk in and ask for $6,000 to pay a contractor, the automated software flags the deviation immediately. It does not know you are putting on a new roof. It does not care that you have a perfectly good reason. It sees a pattern break and it reports it. Round numbers trigger it. Frequent smaller deposits trigger it. A large deposit that does not match what the bank knows about your typical income triggers it. This is exactly why the single smartest move anytime you are about to make an unusual transaction is to walk in with the paperwork that tells the story. A receipt, a contract, a simple written explanation of where the money came from or where it is going. Bring the documentation and the flag resolves itself quietly. Come in empty-handed with an unusual amount, and the system does the rest on its own. Number 4, the new law that lets your bank lock you out of your own money for 15 days, and the one 5-minute phone call that stops it from ever happening to you. In the last few years, banks and brokerage firms across this country have been given the legal authority to place a temporary hold on the account of any customer who is 65 or older the moment they believe that person may be the victim of financial exploitation. The hold can last 15 business days. It can be extended even longer than that. The intention behind the law is genuinely good. It was designed to stop scammers from draining a grandmother's $80,000 in savings before her family even realizes what is happening. But the exact same law means that a sharp, clear-headed, fully capable retiree can walk into their own bank, ask to withdraw $20,000 of their own money to help a grandchild with a down payment on a home, and be quietly walked into a private back office, asked who requested this withdrawal, asked whether anyone is pressuring them to make this transaction, and told to wait up to 15 business days while the bank decides whether to release funds that are 100% legally theirs. There is no age at which this protection turns off. There is no way to opt out of it, and arguing with the teller or the branch manager does not move the clock forward by a single minute. The one move that prevents all of this is a phone call you make before the transaction, not during it. Call your branch. Tell them a large withdrawal is coming and approximately when. Ask them to note it on your account. Give them the name of a trusted contact person they are allowed to call if they have questions. That one 5-minute call is the difference between walking out with your money the same day and waiting 2 weeks to access funds that were always yours to begin with. Number 5. The protection line that most seniors have never actually checked. And what happens to everything above $250,000 if your bank fails? Every account at every bank in this country is insured by the Federal Deposit Insurance Corporation, the FDIC. But that insurance has a ceiling. It only covers you up to $250,000 per person, per bank, per ownership category. If you have $300,000 sitting in a single account at a single bank and that bank fails, $50,000 of your money is simply not insured, and you can lose it permanently. People say bank failures are something from their grandparents' era. In 2023, this country watched 3 of the largest bank collapses in its entire history happen inside the span of about 10 weeks. The depositors who were under $250,000 were fully protected. The ones sitting above that line were left waiting, worrying, and hoping that a political decision would go their way. There is no law that requires anyone to repeat that rescue. The fix is completely straightforward. If you are above $250,000 at one institution, spread it across more than one bank, or use different ownership categories at the same bank. Every dollar comes back under federal insurance protection, and it costs you nothing but one afternoon to arrange it. Number 6. The joint account mistake made out of love, and why it may be the single most dangerous thing on this entire list. At some point, someone close to you told you that the simple thing to do was to add one of your children to your bank account, so they can help pay bills, so things go smoothly if something happens to you, so the money does not get tied up in probate. It sounds logical. It sounds loving. It is one of the most financially dangerous decisions a senior can make, and most families have already made it. The moment you add your son or daughter as a joint owner of your account, that money is legally theirs right now, not when you pass away, right now, today. Which means if that child goes through a divorce, your account can be pulled directly into those proceedings. If that child is sued, is in a serious car accident, owes $40,000 in back taxes, or files for bankruptcy, a creditor has every legal right to come after the money sitting in your account. Any single joint owner can walk into that bank and withdraw every dollar without asking you. Without asking the other children, without asking anyone at all. I have watched this tear families completely apart after a parent is gone, and by that point, there is nothing anyone can legally do. Adding a child to your account can quietly disqualify you from Medicaid benefits at the exact moment in life you need them most. It can create unexpected gift tax complications, and it can completely override everything you carefully wrote into your will, because a joint account passes directly to the surviving owner the moment you are gone, regardless of what your will says. What felt like the loving, simple thing ends up delivering your life savings to a lawsuit, an ex-spouse, or one child instead of all of them. Number 7. The free 10-minute fix that is sitting at your bank right now waiting for you to ask for it by name. Instead of making your child a joint owner, you walk into your bank and you ask for something called a payable on death designation. The abbreviation is POD. While you are alive, you remain the only legal owner of that account. Your children have zero access, zero ownership, zero ability to touch a single dollar, which means no creditor of theirs can reach it, no divorce can claim it, no lawsuit can touch it. The moment you pass away, the money transfers directly and immediately to the exact people you named. No probate court, no lawyer, no waiting period, no judge deciding anything. It does everything people think a joint account does, and it carries none of the risk. It is completely free to set up. It takes one short conversation at your branch, usually 10 minutes or less. And while you are sitting in that chair, do one more thing. Look honestly at how much money is sitting in your regular checking and savings account. The answer to how much actually belongs there is 3 to 6 months of your normal living expenses. For most retirees in 2026, that number lands somewhere between $15,000 and $25,000. That is your cushion. That is your emergency fund. That is the cash you can reach in 24 hours when life happens. Everything above that number is sitting in the wrong place. It is being monitored. It is barely earning anything. It is losing real value to inflation every single month. And depending on your total, part of it may not even be federally protected. Move the rest. Put it in a high-yield savings account at an online bank that is right now paying around 4%, which is roughly 10 times what your regular bank is paying you on that exact same money with that exact same federal insurance. Buy treasury bills directly from the US government at a website called treasurydirect.gov, where the interest you earn is completely free from state income tax. Put a portion into Series 1 savings bonds, which are specifically designed so that inflation cannot eat your money, because the rate they pay moves with the cost of living. Use certificates of deposit spread across multiple banks so that every single dollar stays under the $250,000 insurance limit and earns a guaranteed fixed rate. You keep full control, full access, full protection. And for the first time in years, your money is actually working for you instead of working for the bank. Let me pull all 7 together now, because the same thread runs through every single one of them. The $10,000 report is real, and your bank will never sit you down and explain it. The structuring law will come after you hard for trying to be careful with your own legal money. The suspicious activity report can be filed on any transaction, as small as $200, and you will never be told it happened. The bank can freeze your account for 15 days under a law that was written to protect you. The FDIC only covers you up to $250,000, and most seniors have never once gone and verified where they actually stand. The joint account built out of love is a legal trapdoor, and the payable on death designation that fixes almost all of it is free, takes 10 minutes, and is available at every bank in this country right now. The IRS is not going to send you a letter explaining how to keep yourself off its radar. Your bank is not going to call you and explain how to earn 10 times more on your savings somewhere else. The day your money moves is the day they lose it. The entire system is built to keep everything exactly where it is, quietly working against you until the moment you decide to move first. You now know the number. You know the trap that feels like caution. You know the freeze disguised as protection. You know the joint account dressed up as love. And you know the free 10-minute fix that changes everything. The only thing left is to make the call. I will put every form name, every government website, and every specific step you need in the description below so you have it all in one place. Now, do one thing for me. Send this to one person over 60 who still keeps most of their savings sitting in a single bank account. Your mother, your father, your brother or sister, a neighbor, the friend from church who just lost a spouse and is about to add one of their kids to the account because somebody told them it was the easy thing to do. The odds are very strong that at least one of these 7 things is putting their money at risk right now, today. And one share from you could protect savings they spent an entire lifetime building. That is exactly what we are here for. I will see you in the next one.